Just 2% of Bitcoin wallets control over 95% of all Bitcoin in existence. Let that sink in for a moment. In a currency that was specifically designed to decentralize wealth and take power away from banks and institutions, the concentration of ownership is more extreme than almost any traditional financial asset on the planet. The people and entities sitting at the top of that pyramid hold more purchasing power than some entire nations. And a few of them got there in ways you would never expect. In the next 10 minutes, we are going to walk through exactly who the biggest Bitcoin holders in the world are right now, from mysterious early wallets that have never moved a single coin, to publicly traded companies that are buying Bitcoin faster than miners can produce it, to a handful of governments that ended up holding Bitcoin not by choice but by force. We will cover the data, the history, and the strategies. And right at the end, we will reveal something about one of these holders that completely flips the narrative on who actually controls Bitcoin and why it matters for every single person watching this video. Let us start with a little bit of history to understand how we got here. When Satoshi Nakamoto launched Bitcoin in January 2009, there were no exchanges, no wallets, no apps. There was just a network, a white paper, and a small group of cryptographers running nodes on home computers. In those early days, Bitcoin was mined for almost nothing. Blocks were solved quickly and the reward was 50 coins per block. The people who were paying attention back then accumulated massive amounts of Bitcoin at essentially zero cost. Many of them forgot about it, lost the keys, or never imagined it would become what it is today. But some of them held on. And those early wallets represent some of the most significant concentrations of Bitcoin wealth anywhere in the world. Now let us get into the actual holders, because this is where it gets genuinely fascinating. The single largest known holder of Bitcoin is almost certainly Satoshi Nakamoto himself, herself, or themselves, because we still do not know who Satoshi actually is. Researchers and blockchain analysts, most notably Sergio Damian Lerner, have estimated that Satoshi mined approximately 1 million Bitcoin in the early days of the network. At today's prices, that is a holding worth somewhere between $60 and $70 billion, depending on the moment you check. Here is the remarkable thing: not a single one of those coins has ever moved. Not during the 2017 bull run. Not during the 2021 peak. Not ever. Either Satoshi is extraordinarily disciplined, or those keys are simply lost forever. Either way, that Bitcoin is effectively removed from circulation. Moving from the mysterious to the institutional, MicroStrategy, now rebranded as Strategy, is the most aggressive corporate Bitcoin buyer in history. As of early 2025, the company holds over 500,000 Bitcoin on its balance sheet. Their executive chairman Michael Saylor has turned corporate treasury management into what he calls a Bitcoin acquisition strategy, issuing debt and equity specifically to purchase more Bitcoin. The average purchase price across their entire holding is somewhere around $66,000 per coin. Critics have called this reckless. Supporters have called it visionary. What nobody can dispute is that it is one of the boldest financial bets any publicly traded company has ever made. But here is what nobody talks about: the fact that MicroStrategy's strategy has actually encouraged dozens of other companies to follow the same playbook. Marathon Digital, Riot Platforms, Tesla, Block, and even some smaller firms in Asia and South America have all added Bitcoin to their corporate treasuries. The institutional floodgates, once cracked open, tend to stay open. Next on the list, and this one surprises most people, are the United States federal government and several other national governments. The US government became a massive Bitcoin holder not by buying it, but by seizing it. Through law enforcement actions including the takedown of the Silk Road Marketplace, the Bitfinex hack recovery, and other criminal proceedings, the US government accumulated over 200,000 Bitcoin at various points. Much of that has been sold at auction over the years, but significant quantities remain in government custody. Germany made headlines in 2024 when it seized and then rapidly sold roughly 50,000 Bitcoin from a piracy-related case. El Salvador, on the other hand, went in the opposite direction. They became the first country to adopt Bitcoin as legal tender and have been steadily buying and holding ever since, with their holdings now exceeding 5,000 coins and growing. Let us talk about the exchanges and custodians, because this is where the data gets a little blurry. Companies like Coinbase, Binance, and Kraken hold enormous quantities of Bitcoin on behalf of their users. Coinbase alone is estimated to custody somewhere between 800,000 and 1 million Bitcoin when you account for both retail and institutional clients. Technically, that Bitcoin belongs to the users, not to Coinbase. But in practice, the exchange controls the keys. This is exactly why the phrase "not your keys, not your coins" became such a defining principle of Bitcoin culture. The collapse of FTX in 2022 was a brutal reminder of what happens when users trust a custodian that is not operating honestly. Now let us zoom into the world of ETFs, because this is one of the most significant developments in Bitcoin ownership in the last several years. When the US Securities and Exchange Commission approved spot Bitcoin ETFs in January 2024, it changed everything. BlackRock's iShares Bitcoin Trust, known by its ticker IBIT, became one of the fastest-growing ETFs in financial history. Within months of launching, it had accumulated over 500,000 Bitcoin in custody. Fidelity's Wise Origin Bitcoin Fund added another 150,000 or so. Combined, the major US spot Bitcoin ETFs now hold more than 1 million Bitcoin, representing roughly 5% of the total supply that will ever exist. These ETFs are backed by real Bitcoin, held by qualified custodians. When you buy a share of IBIT, BlackRock goes out and buys actual Bitcoin. This is not hypothetical exposure. This is real accumulation happening every single trading day. But here is the deeper question that the ETF story raises. Is institutional accumulation through ETFs actually good for Bitcoin, or does it recreate the very centralization that Bitcoin was designed to escape? When a handful of asset management firms control millions of coins on behalf of passive investors who never hold their own keys, you have effectively rebuilt the banking system with a Bitcoin wrapper around it. That is not a comfortable thought for Bitcoin purists, but it is the reality of where the market is heading. Let us also acknowledge the early retail whales, individuals who were not institutions, not governments, not exchanges, but regular people who bought Bitcoin early and held it. The Winklevoss twins, Cameron and Tyler, famously purchased approximately 100,000 Bitcoin in 2013, partly using settlement money from their Facebook dispute with Mark Zuckerberg. They have held most of it ever since and are now Bitcoin billionaires many times over. Tim Draper, the venture capitalist, purchased nearly 30,000 Bitcoin at a U.S. Marshall's auction of Silk Road coins in 2014 and has consistently refused to sell. These individuals are not just wealthy, they are ideologically committed to Bitcoin in ways that make selling feel antithetical to everything they believe. The real-world implication of all this concentrated ownership is significant and cuts in two directions. On one hand, it creates stability. When the largest holders are ideologically committed long-term holders, whether that is Satoshi who never sells, MicroStrategy who keeps buying, or ETFs that only sell when investors redeem, it reduces the available supply dramatically. Basic economics tells you that shrinking supply with consistent or growing demand pushes prices higher over time. On the other hand, the concentration of Bitcoin at the top creates systemic risk. If MicroStrategy ever faced a margin call large enough to force a liquidation of its entire position, the market impact would be severe. If the US government decided to sell its remaining reserves in a single auction, the price shock would be felt globally. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to BlockVault Daily for a brand new video every single day. We will see you in the next one.